Stop scrolling. What just happened in silver isn't just a market blip. It's a signal the financial world is waking up. One moment, everyone's yawning. The next, prices explode, shelves empty, and skeptics start sweating. This isn't hype. This is a wake-up call about trust, money, and what could happen in the next few years. Silver isn't just a shiny metal. It's a stress test for the system, a thermometer for confidence. Today, we break it all down. Why prices surged, why physical metal matters, and what this tells you about the invisible forces shaping the markets. For years, silver has been overlooked. People focused on gold, stocks, and crypto, while silver quietly held its ground, ignored and underpriced. The mainstream shrugged when it moved a few points, calling it insignificant, while the broader world continued to shift around it. Debt levels climbed, interest payments rose, inflation crept higher, and everyday expenses like groceries and energy squeezed households. Most people didn't notice, or were told it wasn't a problem, because the numbers in financial reports still looked tidy. But real life isn't tidy, it's messy, and the pressures were building quietly behind the scenes. When silver recently surged, it revealed a gap between perception and reality. Futures markets flashed triple-digit numbers, spot prices jumped, yet physical availability lagged behind. People could see the price on a chart, but trying to buy actual coins or bars often meant back orders, higher premiums, or empty shelves. That gap isn't a conspiracy. It's the natural outcome of a market under stress, a system where physical supply is finite and demand can spike instantly. The real problem is how many people misunderstand the market mechanics. They assume the number on a screen equals what they can buy, ignoring the differences between futures contracts, spot prices, and tangible metal. That misunderstanding creates confusion, panic, and costly mistakes. Retail buyers get nervous when dealers pause orders. Social media amplifies every rumor, exaggerating both shortages and oversupply. Even experienced investors are not immune. They watch the headlines, chase spikes, and let emotion dictate decisions. The truth is simple. Volatility is normal in markets under stress. Industrial demand is real, monetary systems are strained, and psychological factors drive sudden buying frenzies. Silver's recent moves aren't random. They're signals about scarcity, trust, and confidence in the financial system. Ignoring these lessons can be dangerous. Buying at the wrong time, misunderstanding premiums, or relying only on digital prices can erode potential gains. The problem isn't silver itself. It's how the system works, how people react, and how unprepared many are when stress exposes the hidden gaps between price, supply, and reality. Understanding that difference is critical if you want to navigate not just silver, but any financial market during turbulence. Now, let's zoom in on what makes this moment different and why you need to pay attention. Imagine the market as a massive stadium. For years, silver sat in a quiet, empty section. Gold, stocks, crypto, they had the spotlight, the velvet ropes, and all the attention. Silver? It was the underpriced ticket nobody cared about, quietly waiting in the wings. Then suddenly, the crowd rushes in and chaos erupts. Prices spike, premiums widen, and the gap between paper numbers and physical metal becomes painfully obvious. What you see on charts is only part of the story. The real drama is in supply, availability, and human behavior. Here's the tricky part. When markets act like this, two forces collide. First, latecomers flood in, chasing gains without fully understanding what they're buying. Second, the underlying pressures driving the move, industrial demand, monetary stress, psychological fear, start reshaping the system quietly behind the scenes. Retail buyers panic, intermediaries hesitate, and shortages suddenly appear even when production hasn't changed. The result? A surge in premiums, tension in the supply chain, and headlines that scream crisis or opportunity depending on who you listen to. This isn't just speculation, it's a stress test. Futures markets, spot prices, and physical metal behave differently, and misunderstanding the difference can cost you. Futures are contracts, spot is a reference price, and physical is what you can actually hold. When the system is calm, the gap doesn't matter. When volatility strikes, it becomes everything. In this video, I'll show you how to decode these signals without panicking. You'll learn why premiums spike, why physical metal is the true story, and how industrial and monetary forces combine to create sudden surges. You'll also see why social media chatter, influencer hype, and instant expert advice are often misleading. By the end, you won't just see silver as a volatile commodity, you'll understand it as a signal, a mirror for confidence in the financial system, and a guide to navigating uncertainty. Stick around, because we're about to explore the forces behind this surge, the traps to avoid, and the strategy that separates those who thrive from those who chase and lose. Let's take a step back and unpack what's really happening with silver right now. A week ago, the market looked familiar. Silver was hovering near its previous breakout levels. Traders debated whether it could hold, skeptics yawned, and many dismissed it as just another minor move in a forgotten metal. But then something unusual happened. A small dip was immediately absorbed by buyers, almost as if the market refused to let it fall. That's not normal speculative behavior. That's what happens when deep, genuine demand meets a finite supply. Picture the market as a massive stadium. For years, silver sat quietly in the corner unnoticed. Gold had the velvet rope, crypto had the fireworks, and stocks had the spotlight. Silver was the underpriced ticket with the best seats nobody noticed. Suddenly, a wave hits. Retail buyers, institutions, and industrial demand converge all at once. That's when chaos erupts. Price spikes, gaps appear, and premiums soar. If a chart shows $100 per ounce, it doesn't mean you can walk into a store and buy it at that price. The cost depends on the form, mint, availability, and stress on the supply chain. Coins, bars, and government-issued pieces all behave differently, and when demand is frantic, everything can jump overnight. Rumors follow closely behind. Dealers report sold out or nobody's buying. Both statements can be true depending on context. One warehouse may be out of stock, or risk controls may prevent a dealer from quoting prices. Retail buyers panic. Social media amplifies every whisper, and suddenly the market feels unstable, even if the underlying fundamentals haven't changed. That's why scaling in step by step is crucial. Don't chase the hype. Build positions gradually, hedge your risk, and respect volatility. Now let's examine the drivers behind this surge. First, industrial demand. Silver isn't just a shiny metal, it's a critical component in electronics, solar panels, medical devices, and high-efficiency systems. Every electric vehicle, sensor, and solar cell requires it. As the world electrifies, this baseline demand isn't disappearing, it's growing. Second, monetary psychology. Silver is gold's volatile cousin. Gold provides stability, while silver reacts faster to stress. It's thin enough, small enough, and beloved by retail buyers, so it moves violently when confidence slips. Macro pressures intensify the story. Governments run on debt, not balanced budgets. Rising interest rates increase debt service costs. Inflation creeps higher. Citizens notice, savings feel thinner, prices climb, and trust in financial promises erodes. When ordinary people feel the squeeze, they naturally turn to tangible assets, metals, land, and other hard commodities. Silver is often the first wave in the shift. Then there's the psychological element. Many buyers who entered early feel like geniuses and start overestimating their skill. Newcomers chase headlines, hoping for quick gains. Influencers promise certainty or push secret indicators that supposedly reveal the next spike. Flashy plays lure emotional responses. That's why the disciplined step-by-step approach works. Scale in, respect volatility, and focus on what you can control. Allocation, storage, and understanding the metal you're holding. Historical patterns provide further insight. Silver often outperforms gold during stress cycles. Gold climbs steadily, central banks accumulate, but silver compresses years of movement into months. Watching premiums, physical availability, and the gold to silver ratio is critical. A falling ratio suggests silver is outperforming, often a sign that retail sentiment, industrial pressure, and monetary stress are combining. Finally, paper versus physical metal. Futures, spot, and physical are different animals. Futures are contracts, spot is a reference, and physical is what you actually hold. During calm times, the difference is minor. During stress, it's crucial. Intermediaries may back away, spreads widen, and availability shrinks. The price that matters most is not the futures quote. It nests the number that clears physical flow when everyone wants delivery simultaneously. Understanding this separates a one-off spike from a structural market shift. The recent surge isn't random. It's a culmination of industrial demand, monetary stress, retail psychology, and systemic pressure. Premiums widen because dealers manage risk, physical inventory is finite, and real demand outpaces production temporarily. Volatility isn't a sign to panic. It's the system signaling where stress is highest. The challenge is patience, clarity, and understanding what you own, why you own it, and how to navigate the spikes without falling into emotional traps. Even small pullbacks aren't catastrophic. They're normal. Markets known for violent swings, like silver, exhale after explosive runs. The danger isn't the dip, it's selling without a plan. The disciplined approach is to define your allocation, decide what forms to hold, and set thresholds for adding or pausing. Physical metal is insurance. Treat it that way. Don't let charts, headlines, or social pressure dictate your moves. Ultimately, silver isn't just a market. It's a mirror. It reflects industrial growth, monetary confidence, retail psychology, and macro stress. Understanding this story means seeing beyond charts and headlines. It's about identifying patterns, recognizing signals, and making decisions grounded in risk, patience, and long-term perspective. Silver's recent surge isn't just a random spike, it's a message. Not just about a metal, but about trust, liquidity, and the fragility of systems people have taken for granted. When futures and spot prices soar while physical availability tightens, the market is quietly revealing its weak points. Every chart, every premium, every sold-out notice is a clue. This isn't hype. It's a structural stress test unfolding in real time. Let's start with the industrial side. Silver is embedded in the infrastructure of a modern electrified economy. Electronics, renewable energy systems, electric vehicles, sensors, and medical equipment all rely on it. This baseline demand is invisible until stress appears. Then it becomes obvious. When a wave of retail and institutional buying hits a market already tight on production, premiums spike and shortages feel immediate. That is why the price can climb while online listings show back-ordered or call for pricing. The system can't magically create metal on demand. Supply chains are real and they have limits. Next, consider the psychological driver. Silver is small, fast, and emotional. While gold acts as the heavyweight anchor, silver reacts like a sprinter. When confidence in financial systems falters, retail buyers move quickly, often without waiting for perfect conditions. That rush amplifies volatility. Meanwhile, social media influencers and news outlets intensify every move, some trying to scare you, some to lure you in. Recognize this. Your best decisions are never made in the heat of fear or greed. Now, let's connect this to the bigger monetary picture. Debt levels are rising, interest obligations are climbing, and central banks are navigating a complex web of policy, inflation, and currency risk. People notice the squeeze at the household level first. When the math of your budget doesn't match official statements, confidence erodes. That is the psychological pathway leading to metals. A desire for assets outside the system that don't rely on promises, apps, or institutions. Silver is often the first wave in this behavioral shift. And here's the key insight. The market is testing who S-ready and who S-reactive. Those who understand paper versus physical, futures versus spot, and the significance of premiums are in control. Those who chase headlines, react to fear, or assume the spike will continue without strategy, risk being shaken out. The truth is, volatility is part of the signal. It's how the market communicates stress, scarcity, and shifting confidence. Finally, the reveal is simple but profound. Silver isn't just a metal moving in isolation. It's part of a broader real asset trend. Gold stabilizes, silver surges, and multiple hard assets start moving together. That alignment signals a structural story, not just a short-term frenzy. Recognize it, plan for it, and position wisely. The market has provided a window into systemic stress. The people who understand what they're seeing now will be the ones who make disciplined, informed moves as this story unfolds over months and years. In short, silver's spike is a map. Read it carefully. Physical demand, rising premiums, industrial usage, and monetary stress are all flashing lights. Ignore them, and you're reacting blindly. Understand them, and you navigate volatility with clarity, patience, and strategy. This is the reveal. It is not about timing a single trade. It is about seeing the underlying currents shaping markets and positioning yourself to survive and thrive. Now, I want to hear from you. Are you stacking coins, bars, or a mix? Are you watching from the sidelines or actively building a position? Comment below. This isn't about bragging. It's about sharing strategies that actually work. Think about your own approach. Are you focused on signal or noise? Are you reacting to headlines or observing physical scarcity and market structure? Every comment helps us understand the crowd, the sentiment, and the psychology driving this movement. Remember, patience is your friend. Markets will test your nerves, your discipline, and your understanding of fundamentals. Those who respect uncertainty build resilience. Those who chase hype often regret it. So engage thoughtfully, share your experience, and learn from others. Finally, let's connect the dots. Silver's surge is a mirror for trust in the system, industrial demand, and psychological pressure. The story loops back to the same lesson. Plan, understand, and stay disciplined. Futures, spot, physical, they tell different stories, but the patterns repeat. Every spike tests your strategy. Every pullback tests patience. Every premium shift tests understanding. This isn't about predicting the top or bottom. It's about observing the system, respecting risk, and making decisions you can live with. The next chapter? More volatility, more headlines, and more stress tests. But armed with knowledge, scale, and perspective, you can navigate it safely. Silver, gold, and other tangible assets are tools, not lotteries. They protect, hedge, and signal. So loop back to the beginning. Observe the market, understand the mechanics, separate signal from noise, and plan each step. Build positions, learn continuously, and don't chase the obvious move late. That's the strategy that survives, no matter what the charts do next.